Trading in the trend direction isn't just useful, it might actually be the best way to trade every single day. When you follow the trend, you can stack up consecutive winning trades in the same direction without much trouble. There are countless ways to do this, from classic price action concepts to modern indicators that help predict the trend direction and trade accordingly. But here is the problem: sometimes you open a trade in the right direction, yet your portfolio still ends up red. Well, today I've got something extraordinary to fix that. An indicator on TradingView that's perfectly designed for trading with the trend. I won't waste any more time. I'm in a rush to reveal this awesome tool, so lean back, grab a coffee, and let's dive straight in.
Whoa. Here I come. Oh, here I come.
On TradingView, head over to the Indicators tab and type in Trend Speed Analyzer. It is the one created by Zierman. Once you click on it, it'll pop up on your chart in two forms: a trend following line and an oscillator. These two work hand in hand. Let's break down the elements real quick. The red histograms on the oscillator show that the market has bearish momentum, meaning the overall trend is bearish in that zone. You can confirm this visually. The candles are red and the trend following line is sloping downward and red as well. When those histograms switch from red to green, that's your signal of a momentum shift from bearish to bullish. And if you check that very first green histogram, you'll notice it lines up exactly at the start of the uptrend. Candles flip green, push through the trend line, and the line itself turns green too. And at that point, you can confidently open a long trade, because the histograms confirm that the bullish momentum has taken over. Let's quickly check out one more example. In this chart, we can clearly see a momentum shift happening. The green histograms suddenly turn red, signaling that the bullish trend is losing steam and a fresh bearish trend is just about to begin. That was the most basic way to trade using this indicator. Now let's dig a little deeper into how it actually behaves. Sometimes you'll notice that candles break the midline, but then nothing really happens. Price just moves sideways. That is a ranging market. The oscillator confirms this perfectly. The histograms get really small, showing that the trend has no real direction. Here's the key takeaway: the smaller the histograms, the weaker the trend. But then things get interesting. A momentum shift starts forming. The histograms slowly turn green and begin to grow larger. And what happens next? The candles react instantly, pushing the price upward. So in simple terms, the larger the histogram, the stronger the trend. The next point is something every trader faces: fake breakouts, those annoying traps that make you think a massive move is coming. And then boom, your stop loss gets hit before you even sip your coffee. Now here's the thing, fake breakouts are totally normal. But we're not gonna panic or add 5 more indicators to fix it. We're gonna use basic price action. Simple, clean, and effective. Here is how. Just draw a trend line, connecting the major pivots to get a sense of how the trend behaves. This helps you detect fake moves before you jump in. So in this case, we don't enter a trade yet, because the candles haven't broken above the trend line, meaning no real confirmation. A good entry happens only when the candles break both the trend line and the indicator's midline, and that is when the move is legit. The oscillator confirms it. Histograms turn green, showing a clear momentum shift to bullish. Just like that, with one simple trend line and a quick check on the oscillator, you filtered out a potential bad trade and set yourself up for a solid one. Another powerful way to use this indicator is through divergence. Check this chart. The candles are making lower lows, which normally signals bearish momentum and a downward trend. But the oscillator is telling a different story. It's making higher lows, contradicting the price movement. This is classic divergence, which is an early warning of a possible trend reversal. So in this scenario, when the candles break the midline, you can trust that breakout, because the divergence has already signaled that the trend is likely about to flip. On this chart, first I draw a trend line, connecting all the lows. This clearly shows the trend direction, and a breakout from this line can act as a potential trade signal. Next, look at the price action. The price is making a higher high, showing that the market is in an uptrend. But here's the kicker, the indicator is making a lower high. This contradiction isn't just random. It is a divergence, which I treat as a trend weakness signal. Now, with both these signals in mind, once the breakout happens from both the trend line and the indicator line, I'm ready to open a short trade, because the divergence makes this short signal much more likely to be valid, giving me a higher probability setup for a reversal. Here's one more example. On this chart, I draw a support level and simply wait for a breakout. Now notice the price. It's making a higher high, but the indicator is making a lower high. Well, as you know, that's a divergence. If you check the histograms, they are small and weak, which is another sign that the trend is losing strength and adds to the suspicion of a reversal. With all these clues in place, the breakout from both support line and the indicator midline becomes a solid, high-confidence, short opportunity. All the signs line up: divergence, weak momentum, and a breakout, making it a reliable trade setup. Watch this final example for yourself. One last point you need to consider. I am not a financial advisor, and this is not a financial advice. All content, information, and opinions shared in this video are for educational and entertainment purposes only. Trading and investing in stocks, Forex, and cryptocurrencies carries a high level of risk, and you may lose more than your initial investment. Only risk the capital you can afford to lose. Past performance is not indicative of future results. Always conduct your own research and consult with a qualified financial professional before making any investment decisions.